Big tax increases, fiduciary rules, self-directed brokerage accounts, and so much more on today's episode of Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimson and Casey Elkins.
Welcome into Elevate Your Wealth. Your hosts, Mark Stimson and Casey Elkins. You can find them at Elevated Financial Management, the power behind this program, and over 42 years combined experience between these two, helping hundreds of their clients get ready for retirement. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate. Each and every week, we go back and forth on so many different retirement topics. We're going to get into some of the latest hot articles about retirement planning, things that are going to impact you as you move to and through retirement. But first and foremost, guys, man, how was your week?
Oh, it's been great. Yeah, it's been great. You know, things have been going really good around the office. We've met a lot of new folks recently. We've had some nice weather in Seattle, which has been really good. You know, we went to opening day, or I should say I went to opening day.
Yeah, right.
Went to opening day for the Mariners a couple weeks ago. And no, it's been great. You know, it's always fun to see the guys back at the ballpark and, you know, been enjoying the nice weather and just getting out in the city a little bit.
Casey, how many games have you taken in? Sorry, Mark, I'll let you jump in a second, but how many games have you taken in already?
Actually, just one so far.
Just the one?
Which is kind of disappointing. I think last year, I made it to about 15, 16 games last year, and I'll probably do about the same this year. I mean, I'd love to go more, but, you know, it's hard. I mean, with, you know, that many home games, and it's just, it's a lot. But, you know,
well, I was just going to say, several weeks ago, you were really, really excited, really hot for the season to start. How are you feeling? How are you feeling about the Mariners?
I'm still really excited. I'm still really, I'll say this.
Long season.
Yeah, long season. That's like, we got a lot of opportunity here. You know, I just like on the show, we like to keep it positive, right? So I'll say that even when they don't pull through like we want them to, it's still fun to watch them play. And, you know, they're still working out some kinks, right? And unfortunately, some of the players that have been traded away are playing really, really well outside of Seattle. But, again, we're not going to focus on the negative, right? So it's always fun to watch the guys play. And I think it'll be a good year. But, you know, Mariners historically slow start, right?
Yeah, it's that part's the part that's a little discouraging right now, right? They got to change that. And I know I've been working. I almost got my backyard done, so that's what I'm doing, man. I wish I could go to more games, but
what all are you doing in your backyard, Mark? What are you doing?
Completely redid it. I live on a little lake, and so I finally got all the paths and everything in. I'm ready to finally hydro seed that baby, and it's been dragging on, as Casey knows, for close to 4 years now. So I am tired of this backyard looking at dirt and weeds. I'm gonna have a nice little mat all the way to the water, baby. So I'm looking.
You're listening to Garden Goobers. Thanks for tuning in. No. Yeah. I tell you, I love to get outside myself, and you know, a lot of people are. You know, it's that time of year. People are really kind of focusing in on the birth of a new season, and it's going to be warmer weather. We're going to be getting outside. We're going to be active. It makes you think about a lot of things, and we get into retirement planning discussion, and you know, that's what you're aiming for. That's what you're saving for. You want to be able to enjoy your retirement. You want to be able to get out and redo your backyard, or you want to go to a Mariners game and be a season ticket holder. You want to be able to relax and enjoy your time in retirement. So we get into so many different areas when it comes to planning, but you guys have come up with a number of articles that are, you know, they're on point. So let's talk about them. This first one, Biden administration proposes big tax increases on the wealthy. I'll just throw it to you guys. What kind of piqued your interest here, obviously, because this is going to impact a lot of retirees?
You know, in reality, I think this is so key because taxes do have a huge impact on retirees, right? We talk about that a lot. And it's something that we know a lot of advisors don't want to talk about taxes, or maybe they're not even allowed to talk about it depending on certain circumstances. But for us, we think that's such an important piece of the puzzle when it comes to retirement. And so, you know, you mentioned the title of the article. Again, Biden administration proposes big tax increases on the wealthy. And so, you know, we understand that maybe what we're about to talk about here doesn't apply to every listener that we have, or even to all the clients that we have. But we know that a lot of times these tax changes start at the top and then they work their way down. So if they're raising taxes on the wealthy or proposing those changes, that will likely have a trickle-down effect. So if you're listening to this and you're thinking, well, I don't have $10 million or I don't make $1 million plus a year, that kind of thing, that's okay. Most of our clients are not like that anyways. But the key here is that this is potentially a foregleam of what's coming and some of the changes that will trickle down to everybody. So that's why we wanted to talk about it. And, some of these changes potentially have an impact starting this year, right? These are not approved yet, but there are a number of things here to talk about. You want to add anything to that, Mark?
Yeah, I was just going to say, one of the big ones to really keep your eye on is what the top federal marginal tax rate. We know right now it could get hiked about another, 2.5% from 37 to 39.6. That, of course, is going to apply to those that make over $400,000. A lot of you out there are going, well, I don't make $400,000, so it doesn't really affect me. But, these things are going to be indexed for inflation after 24, and this effective for tax years beginning this year, like Casey, it started after December 31st of 22. So these do matter. These rates are all increasing. I think we all know that. And it could be even higher. Trump's plan, we know, sunsets the end of next year, the end of 25. So again, another thing that we might want to talk about too in this regard with the rates going up, Case, would be capital gains and qualified dividends. What about those?
This is really a big deal. So long-term capital gains, there's an advantage in terms of taxes for long-term capital gains. So for the uninitiated, we can say it this way: if you hold an investment for more than a year, you qualify for special tax treatment, meaning that you would likely pay for what we're talking about here. You would pay capital gains rates, long-term capital gains rates of either 15 or 20%. What this new proposal is saying that those with taxable income exceeding $1 million, they would no longer have that favorable tax rate, and it would just be taxed at regular income levels. Now, that is a big deal, because when you start talking about higher net worth folks, they have a lot of appreciated investments, right? Investment accounts that they have yet to pay taxes on, and they receive, like I said, that favorable tax treatment because they held the investment for over a year. And so this does have a big impact on the wealthy, but really the key that we're focusing on here is how this potentially trickles down in the future, because it starts at the top, but this will have an impact over time, maybe not right away, but over time on those that are earning $100,000 or $150,000 a year, right? That will have some type of trickle down effect. And so we want to figure out, what can we do? How can we have a positive impact now and in the future? What can be done today to create that positive impact?
I tell you, it's so important to be on top of what's going on and be ready for it. Again, we say this often: retirement doesn't happen in a vacuum, and things are going to impact you as you move to and through retirement. And if there are going to be big tax increases anywhere on the spectrum when it comes to earners, it's going to eventually come to you. And how are you going to handle it? Opportunity to get on the calendar with Elevated Financial Management ongoing during the course of this show. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. You can call right now and secure one of the appointments. 866-668-3625. You leave the checkbook at home. Again, 866-668-3625. Limited number of these, but again, they are complimentary. 866-668-3625. Any questions about how tax is going to impact you and your portfolio as you move to and through retirement? Great opportunity to have that kind of conversation. But back to the article. Again, Biden administration proposes big tax increases on the wealthy. Keith Grissom penning this one. Now, with everything that's going on, retirement plan changes for those high-income earners, and also which makes them high-income taxpayers.
Mm-hmm. Yeah. This is something that everybody out there that is 400 to higher in the amount of income, you need to be concerned about what's coming. We're not going to get into the total specifics of this, but this is why it's so critical that you work with a firm that will address taxes with you, because if you don't, it's going to be an issue. And so you need to have some sort of a quarterback, to run your plan, including the tax planning aspect about this. And I'll tell you, one of the things that I'm really worried about in this connection is when I have a lot of clients where we use trusts. Grantor trust and estate and gift taxation is a big deal. And some of the things that are coming is one of the latest proposals is thinking about limiting the use of grantor trusts in planning. And it's also going to impose a tax on unrealized capital gains or in appreciated property in certain situations. So that could be ginormous. And this would include upon, if you're gifting something or upon death. There's going to be lots of different exceptions, but you need to understand what they all are. And if you don't, these changes could come back and bite us. And so please, if you're not working with someone that can incorporate a good plan with you and into your specific situation, you might want to think about talking to somebody that can.
I mean, you think about this too. There's so many out there that are listening to this show that have been really diligent about saving, acquiring, building portfolios, but they don't have a plan. And if taxes come down hard, it can be painful. So you really that needs to be a big part of what you're doing as far as planning. So if you don't have one, if you're a do-it-yourselfer, you guys have an opportunity for your listeners to come in and leave the checkbook at home.
We do, yeah. So for those that are listening and you're worried about taxes, right? Again, maybe you are part of what we're talking about here for the wealthy that have that higher income. Maybe you're worried about how this trickles down to you in the future. And in reality, we think that's where that's going to affect most folks. If you're worried about that, you want to have a positive impact on your taxes, find out what you can do today. You want to figure out how you can avoid some of the stock market volatility that's going on, how to make sure that your income is going to be secure in retirement, how to make sure that anything that you do leave behind passes efficiently to the next generation, as Mark was discussing with trusts and that type of thing. Don't hesitate. Pick up the phone. Give us a call. We will put together a written financial plan put together by our team of certified financial planners.
Here's the phone number, 866-668-3625. That's 866-668-3625. Again, if you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. 866-668-3625. When we return, we've got more of the hot articles on retirement planning, the latest coming up next. Welcome back into Elevate Your Wealth, hosted by Mark Stimson and Casey Elkins, Elevated Financial Management, where you can find them right here in Seattle. Check us out online, great resource website, efmnw.com, all letters, efmnw.com. Again, you can find links to the TV show, Elevate Your Wealth, our radio shows and podcast form are there for you. Great information. Any events coming up, any seminars, any workshops, you'll be able to find that information, efmnw.com. And between Mark and Casey, 42 plus years combined experience. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate. We were discussing the taxes. And again, there's a proposed pretty big tax increase for the wealthy. But it's going to trickle down, as Casey has mentioned. Mark has reiterated that. I mean, it's going to come to all of us at some point. But you guys wanted to have some closing thoughts on taxes.
Yeah, I think this is the one final thing that I really wanted to share with this article. And maybe you've got something else to add to it, Mark, I'm not sure. But for those higher income taxpayers, they are prohibiting or so essentially not allowing Roth conversions. That's a big deal, right? Because to not be able to potentially take advantage of a Roth conversion where we can pay taxes at today's rates instead of what they might be in the future when we choose to take that money out, that is a big planning piece. And that Roth conversion applies for everybody, right? That's something that we do for folks that have much lower net worth than what we're talking about here. That applies for folks that have the very high net worth. That is a good planning tool. So for them to potentially do away with that for the higher net worth and higher income individuals, that will trickle down at some point, right? You can kind of get an idea for what they're targeting to make changes to overall. And so the reason we bring this up is because since that is such a powerful tool, now is the time, right?
Yeah.
If you're thinking about Roth conversion and you're thinking, let's say you're close to retirement within 5 to 10 years from retirement now, maybe you're already retired, now is the time. We are in a tax window of opportunity that we will likely never see again, and now is the time to deal with it. And so especially when we see these proposed changes, this is a foregleam of what's to come for the rest of us, and we've got to take advantage.
Yeah, in fact, it's funny you mentioned that, Casey, because the clients that just walked out of here, they're She worked at Boeing over 30-some years, and that's exactly what we're going to do. She's still got money in her VIP plan, in the stable fund, but their big hot button and what they want to deal with is taxes now. And so we're going to put together a plan for being able to do what we call bracket stuffing for them. We're going to be able to take them, keep them in the 24% bracket, but stuff it to basically around $380,000 total of income. And if we do that, we can convert about an extra $200,000 of our $550,000 401k plan. So that's going to be a big deal, like Casey mentioned. If they get rid of that, there we go, taxes going through the roof again. And the other thing that I think is huge that we need to watch out for is if the government gets rid of the step up in basis at death, that will affect everybody, especially middle income. You won't have to be wealthy for this, because you can imagine if you get stock now and your parents die, you get the stock value at the date of death, whatever it is on that date, right? If they get rid of that, they're going to go back, and let's say the parents hold that stock for 30 years, they're going to go back and make you pay the tax on all of that gain for all of those years. And it would have to do with stock, highly appreciated stocks, and also real estate. So that could be devastating to middle income Americans. Casey, you got something?
Yeah, I think what I'll add to that is kind of going back to that Roth conversion piece. You know, we teach out, I mean, Morgan, you know this, right? We teach at Bellevue College, at Green River, Renton Tech. We teach at a lot of colleges here locally in different venues, and classes specifically based on retirement. And we talk about Roth conversions a lot. And this was brought up last week during that class. The question was, well, a Roth conversion sounds great, but I'm going to have less income in retirement, right? So why would I choose to pay taxes now when in the future I'm going to be in a lower tax bracket? And so maybe folks at home are thinking about that. There's two things we can say. Number one, let's say you will have less income in retirement, which I'm going to come back to that thought in a second. But let's say you are going to have less income in retirement. Are you actually going to be in a lower tax bracket, right? That's the question. You may have lower income, but you could very well be in the same tax bracket.
Right.
So then that kind of throws that out the window, right? It does make sense to convert if you're going to be in the same tax bracket later. Now, here's the second piece to that. Are you actually going to have less income? For a lot of people, they're going to have similar income, maybe a tiny bit less, but 90-95%. We actually have some clients who are going to have more income in retirement than they did when they're working. And the reality here is that it's a falsity to think that you're going to have less income in retirement if you have saved and if you have planned well and those kinds of things, because you likely are not going to have a big cut in your lifestyle in retirement, which means you're going to need a similar income. And so we really have to pay attention. Sometimes these, like I said, falsities can be put out there that, oh, we're just going to have less income, so we're not as worried about taxes. And that may be the case for you. But for a lot of folks, it's not. And so that Roth conversion becomes so important, and it's something that we have to take advantage if we have the opportunity.
I mean, it's crucial to, take a look at. And as you guys have said many times on the show before, if taxes are on sale right now and they're going to pop up at the next couple of years, why wouldn't you at least have that conversation about a Roth conversion? Now, the opportunity to have that conversation, to have that chit-chat, to do that with Elevated Financial Management, with Casey, Mark, their team, it's ongoing during the course of this show. We have a limited number of spots for our radio listeners, but these are complimentary. You leave the checkbook at home. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. All you got to do is call 866-668-3625. That's 866-668-3625. All right. Now, during the break, off air, we were talking about reverse mortgages. And Mark, you're big on this. This is a headliner. So let's just kind of go ahead and get into it. There's been some news.
Yeah, and one of the things I want to say is this when we talk reverse mortgages, it goes along with the A word, annuities, right? And a lot of people just have misconceptions as to how these things work, whether it's an annuity or a reverse mortgage. Do we sell them here? No. We solve problems. One of the things I will say, we don't have a pony in the race when it comes to reverse mortgages. We don't do them here. We don't have any stake at being able to educate people as to how they work. I just understand them, and they are such a powerful tool in the right situation. So, give an example. You can use a reverse in several different ways. One is like what I'm trying to do on my house right now. I built 4 years ago. I have enough equity now. I just need the HUD appraisal to come in high enough, and it's going to pay off my existing mortgage. So my wife and I will be able to live there until we pass away, and it will also go to our children. The mortgage will have to be paid off just like my traditional one that I have now would be paid off. People tend to think, oh, if I do a reverse, then my kids won't get anything. That could not be farther from the truth. You need to understand how they work. That's one way. A great other opportunity is maybe you want to downsize, right? And it's hard to find ramblers in our area here, but maybe you want to downsize. So how cool would it be to find another property? And let's say you have $700,000 in your pocket from the sale of your existing home, and you go and you find a property for maybe, let's say, 60% of the value of a home. So let's just use $600,000. You find that. How cool would it be to put down maybe $360,000 on that property, keep the rest of the money in your bank, and have the house paid off, and you have no payment. You have taxes and insurance, but you got that whether you have a mortgage, whether it's traditional or not. So there's some really powerful ways to use a reverse mortgage. And I have several clients that have them, and they are so grateful that they learned how they actually worked, because it has been a game changer for them.
Let me ask you something, Mark. Should everybody consider a reverse?
No.
Yeah. Then I think that's kind of the big big thing to consider with this, right? Is that it's not a fit for everybody, right? And that's okay. It doesn't have to be. The reality is that heavy risk in the market is not a fit for everybody, but it is a fit for some. Annuities are not a fit for everybody, but it is a fit for some. Mutual funds, depending on how they're invested, are not a fit for everybody, but they are for some, right? And really what we're trying to do, talking about reverse mortgages, as Mark said, we're not the reverse mortgage guys. That's not what we do. But it is a valuable tool, and it's something to be educated about and see if it makes sense in your plan. Maybe it does, maybe it doesn't, but you should have the conversation.
Yeah, it's about having options. We talk about it all the time. Again, Mark and Casey are the advisors, but you're going to be the decider. You're going to be the end, right? You're going to have a lot of things. It's like going to a buffet. And, you're going to make the final decision on what you're going to put on your plate. Same thing goes for retirement planning. You're going to have, an advisor sit down with you and make suggestions. Mark, Casey, whomever you're sitting down with. And then you have to make a decision. But these are informed decisions, so you're in a better spot. All right, so Mark, we've got spots on the calendar. What are we going to do for these people?
Yeah, now if you've been listening and maybe you've worked at Boeing, you've saved at least $250,000 or more, these strategies that we talked about are really going to be beneficial for you. So please pick up the phone. Let our team of financial planners, certified financial planners, work on a plan for you. Maybe you're thinking about a reverse mortgage, how that might change your retirement or when you could retire. What about taxes? Do you have a tax efficient plan? Is your income guaranteed? Please pick up the phone. Let us keep the checkbook at home. As Morgan always says, you don't have to pay us a dime for us to put together a plan for you. So please pick up the phone, give us a call, let us help.
Limited number of spots. They're available right now. 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. 866-668-3625. One more time, 866-668-3625. Latest, hottest articles about retirement planning. We'll get to more of those coming up next. Welcome back into Elevated Financial Management's Elevate Your Wealth. Mark Stimson and Casey Elkins are your hosts. Over 42 years combined experience between these two. And again, it's always about getting their clients ready for retirement and planning and creating that roadmap to get them there. And not just get them there, but get them through retirement. It's all about the plan. They are certified financial fiduciaries. I'm Morgan Patrick, consumer advocate. We get it. You're busy. Man, this area is such an outdoors part of the state. You guys are going to be out and about. If you want to to check out the website at any time, you can. EFMNW.com, all letters, EFMNW.com. Links to the TV show, radio show, and podcast form. Great information. Any event that's coming up, you'll be able to find out more information there. Again, that's EFMNW.com. So we're hitting some of the latest articles that are out there. We're going to jump to this one. Tara Siegel Bernard pinning this. Biden administration to release final fiduciary rules soon. Gentlemen, this caught your eye. Why so?
Yeah, this really did. And let me, I'll read the very first sentence out of this because this is what really caught me. It says, it seems like an issue everyone can agree on, which, to be perfectly honest, there's very few of those these days, right?
True.
But this seems like an issue everyone can agree on. Financial professionals should be required to handle retirement money with the utmost care, putting investors' interests first, right? So acting as a fiduciary. That's what that means, putting the client first. Despite any personal gain or anything like that, the client always comes first, always is number one. It says that financial professionals should be required to do that, which indicates that they're not required to do that, right? Which is a problem. And Mark and I feel that's a huge problem in our industry, that being a fiduciary, acting as a fiduciary is not the minimum standard of entry. I'm a firm believer that that should be the minimum standard of entry. If we're going to plan somebody's lifetime retirement, it should, at the minimum, be required that we do the absolute best thing that we can for that client. Always they're put first. And that's not the industry standard, right? We see a lot of folks that do not have to abide by that and don't abide by that in their recommendations and their planning. And it does take more work. It does take more time to be a fiduciary. It does require ongoing education and understanding all the options and possibilities that are out there. It is more difficult, but that definitively should be the minimum point of entry.
So, gentlemen, listeners, they're tuned into us and they're saying, okay, I sit down with somebody. How do I know? What do I do? They need to blatantly just ask, are you a fiduciary?
Yeah. And that's a great point, Morgan, because Casey and I, when you get securities license, certain securities license, a 65 or a 66, you automatically get that title. But I tell people, and Casey and I talk about this in our classes all the time, Bernie Madoff was a fiduciary. Right? How'd that work out for everybody, right? You still have to do the right thing. So we can have all the titles behind our names that we want, whether it's all attorneys in the United States are supposed to be fiduciaries. I think we know how that works out for everybody, right? So again, but there's a big difference between a true fiduciary standard and a suitability standard. And that's what Casey was just mentioning. A lot of the brokers in the broker-dealer world, they work off of the suitability standard, not the fiduciary standard. It doesn't mean that the suitable standard isn't good, but it necessarily is not always in the client's best interest. And so, again, please, Casey's right on the money with this. You need to be working with somebody that's always going to keep your interest first, no matter what. And that is what a true fiduciary is going to do.
Yeah, we think, like I said multiple times, we think that that's the minimum barrier of entry into our industry. We think that should be required of everybody in the financial world to put their clients first. Honestly, I think that should apply in every industry, right? That whatever professional capacity you're acting in, you should be required to act in your client's best interests. But I'll save the commentary on everything else. We're just talking about finances today, right? But ultimately, that is key, because just because something is suitable for you does not mean that it's necessarily the best thing for you, right? So it may pass the quote-unquote best interest standard, meaning that it's suitable, it might work, but is it truly the best thing for you? And we think that's where you just need to blatantly ask, like you said, Morgan, right? Are you a fiduciary, right? And what does that mean to you, right? You can ask questions beyond that. You should ask questions beyond that, right? When we're talking with people that come into our office from radio or from our workshops or wherever they come from, we fully expect that they're going to grill us to some extent, right? Because this, in reality, is supposed to be a long-term relationship, right? I mean, it's like a marriage, and we wouldn't expect you to go into it without knowing the other side.
You guys have been in this business, and you're fiduciaries, you're certified. Why haven't we gone to a universal across the board, you've got to have it to be in the industry? I mean, enlighten me, enlighten our listeners. Why is that not almost a you have to have it?
Yeah, and this is something that everybody questions, right? Why hasn't it always been this way? And I think the easiest way to answer that is it just wasn't required. It wasn't required by the securities industry. It wasn't required by the insurance industry, the banking industry. All of the financial things that we are trusting individuals with our hard-earned retirement dollars, it wasn't a requirement. But it's becoming more and more important. And that's why we're seeing organizations like the Biden administration say, you know what, if you're going to mess with people's, or help them, not mess, but help them with their retirement monies, hopefully not mess it up.
Right. Hands on, right?
Yeah. You need to be doing the right thing, and that requires the fiduciary standard. Just like all the ERISA plan administrators that manage 401ks, they're supposed to be true fiduciaries, always putting the interest of the participants at the front of the line, you might say. But we know that that hasn't always worked out. All you have to do is look at plans like Detroit in the 80s and all those plans that went down the drain. So again, you can have all the titles we want, but you still need to do the right thing, and that really is the bottom line.
And, you just have. Oh, I'm sorry, Morgan. Go ahead.
No, I was just going to say, you got to ask. You got to ask when you sit down. What were you going to say, Case?
Well, I think it's important to note that you have, as Mark said, it hasn't always been that way, and in our heads it should be, right? I think a lot of people think that it is, right? But you also have, as I mentioned earlier, it's more complicated. It's more difficult. There is more required of us as a planner to be a fiduciary, and so you have a lot of folks that push against it, that don't want to be held to a fiduciary standard, that don't want to deal with the additional work and regulation that comes with that. And we think that that should be, right? We think that that's valuable. And ultimately, it makes it better for the client. That's really what it is. So, they are kind of working towards that. There is some proposes for that. And it's always being argued back and forth as to what that new standard is. And we just continue to do the best that we can for our clients, continue to try and meet those standards, exceed those standards, I should say. And ultimately is something that we're proud of, to be fiduciaries. And as you mentioned, certified financial fiduciaries. It's a big piece of the puzzle.
Big piece, and you need to start asking those questions. And there's an opportunity to get on the calendar with Elevated Financial Management, meet with Mark, Casey, and their team. And these are complimentary. You leave the checkbook at home, an opportunity to kind of go through what's going on with you. If you are sitting on a portfolio that is not a plan, certainly you've done an amazing job of accumulating and saving, and you're getting ready for retirement, but you really need that roadmap. Call this number, 866-668-3625, cost-free. They'll take a look, see how you're doing. They're fiduciaries, and if you're doing okay, they're going to tell you. But they're also going to suggest possibly maybe a pivot, a change here, a change there. But these are options for you. Call 866-668-3625. Secure one of those appointments. Again, if you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call 866-668-3625. All right, so I want to jump to this article, guys. You sent it to me. It caught my eye as well. Do advisors give self-directed brokerage accounts an advantage?
Absolutely, we think that they do. And this article is really interesting. There's a couple of main points that we'll draw out. I'll start with one, and I'm sure you'll add a couple things to it, Mark. But here's a thought that on average, those with advised accounts made more trades. That seems logical, right? You have an advisor; they're more actively trading the account. So that's a statistic that 12.8 total trades in an advised account, whereas 9.1 for non-advised. That statistic is one thing, but what it really means is that there's somebody more actively watching the money, right? That's really what this boils down to. Somebody more actively watching the market and understanding what's going on, and the impact that that's going to have on a retirement. And then here's another quote from the article. As might be expected, advised accounts had a more diversified asset allocation mix and a lower concentration of assets in particular securities and a lower percentage in cash, which again paints kind of the same picture that somebody is actually keeping track of this. They're not allowing the cash to be too big, which of course creates drag on a portfolio. And there's more asset allocation mix, meaning there's more diversity, more diversification, making sure that not all of our assets are invested in the exact same way. And so that does have a big impact when somebody is truly keeping track of it and making changes based on what the market is doing, based on what's happening in the world scene, the economy. It's not just kind of sitting there, because we know out of sight, out of mind. That happens with retirement portfolios as well. If you have a self-directed account, you're caught up in your work, you're caught up in your family life, you're caught up in being a parent or a grandparent, whatever it is, you're likely not keeping track of these dollars day to day, but having an advisor does give you that advantage.
Yeah, and I think part of this too is really important that everybody listening really think about, because Forbes maybe a year and a half ago wrote a great article showing that the average portfolio was up significantly with a managed account versus a self-directed or somebody that's doing it themselves. The Schwab pretty much article here saying the same thing. Why does everybody, or the majority of people in this one, over 82%, they do it themselves? We all know the reason, right? Nobody wants to pay a fee. That's what it boils down to, right? But the proof is also in the pudding, from the standpoint that the ones that are paying a fee to somebody that's worth their weight, they're getting more in return. Their portfolios are larger. So again, but they have to be decent, right? We all know there's bad brokers out there. But the point is, those that are using a management fee and paying that are going to do better over in the long haul.
Well, let's help some people out. We've got spots on your calendar. Case, what's going to happen?
Well, for those that are worried that maybe they're not working with a fiduciary, or maybe have never sat down with a financial planner before, want answers about what they can do to invest smartly for the future and create a true written retirement plan that can be tax efficient, create income into the future, optimize their Social Security, help deal with Medicare and all the questions that come surrounding the 4 parts, this is for you. This is a chance for you to have a written financial plan put together by our team of certified financial planners. Don't hesitate. Pick up the phone. Give us a call.
All right, here's the number, 866-668-3625. That's 866-668-3625. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call the number now. Leave the checkbook at home. Get in here, 866-668-3625. When we return, we will get into retirement scenarios. I'll throw them at the fellas. We'll see what they come up with. Welcome back into Elevate Your Wealth. Mark Stimson, Casey Elkins are your hosts. You can find them at Elevated Financial Management right here in Seattle. Check them out online. Great resource website, efmnw.com. Again, all letters, efmnw.com. Links to the TV show, radio show, and podcast form. Great information. Any event that's coming up, check them out online, efmnw.com. 42 plus years combined experience between these two, helping their clients, hundreds of them, get ready for retirement. They are certified financial fiduciaries. We've been talking about that today. I'm Morgan Patrick, Consumer Advocates. Now time for scenarios, and we throw these different situations at Mark and Casey, and we see what they're going to come up with. Now, remember this. If you hear a scenario that's similar to what you're going through, just remember it's not exactly what you're going through. Take it with a grain of salt. And if you've got questions about where you are, what's going on with your situation, you can always get on the calendar with Elevated Financial Management by calling 866-668-3625. That's 866-668-3625. Again, leave the checkbook at home and get a handle on things. All right. First scenario, gentlemen, is this one. How should an individual retirement account, IRA, be managed? Allow it to accumulate wealth and then pay taxes on withdrawals in retirement. That's the first part of the question. Or transfer it to a Roth IRA. Should I pay taxes now and receive my money tax-free later? And again, can the taxes owed on the rollover be deducted directly from the rollover account itself? There's a lot there, a lot to unpack. So start unpacking.
Yeah, that's a lot of questions. And you know what? It's kind of interesting. These questions all lead to one another, right? So once we answer the first question, those other questions kind of come up. And I'll just say that before I answer these, I think it's very telling that as you approach retirement, if you're thinking about how do I invest the right way, how do I deal with taxes the right way, how do I make my income last, and you seem to have all these questions kind of swirling in your mind, that is not abnormal. That is absolutely normal. And that is something that people really start to deal with as they get close to retirement. They start to realize that there's so many decisions that you have to make, and they're decisions you probably haven't made before. And each of the decisions that you make has an impact on the others. And so I think it's interesting the way that these are written out here. So how should an IRA be managed? Well, I mean, gosh, that's a tough one to answer without further detail, just because really the way it should be managed is the way that's best for you, right? If it's your IRA, it should be managed in the best way for you. There's not a one size fits all. There is a custom tailored approach. That's the approach that we like to take. And we think that that's the most appropriate, because your life is different. Your circumstance is different than everybody else's. And so what makes sense in your individual circumstance as to asset allocation and goals for the money? Are we producing income? Are we producing or just looking for long-term growth? Really, what are the goals for those dollars? Do you have pensions outside of your IRA? They're going to provide a lot of income. What's your Social Security look like? And that has an impact on how we invest the money inside of your IRA. So it's hard to give a straight answer to that without knowing more details, right? And that's where we'll say that custom tailored approach is so important, because you do have a unique circumstance. Now, should you allow it to accumulate wealth and then pay taxes on withdrawals in retirement, or transfer it to a Roth IRA? Again, very situational, right? We do think that most folks I don't think anybody's ever going to regret having more money inside of their Roth account, which is tax-free. But does it make sense to do that Roth conversion now, or does it make sense to let the money grow in your IRA? It's situational to you on what your income tax bracket is, what your income will look like in the future. Are you married, or are you a single filer? Again, what other income sources do you have? And so these are all questions that kind of tie in together.
If I could add one thing to that, Casey, one thing I would say to this is, if you're talking about a contribution and you're going to be at work for still several years, then we would tell you hands down, do the Roth over traditional. There's no, conversions are a whole different animal, like Casey was mentioning. But boy, if you have the chance to build up tax-free wealth versus tax-deferred wealth, I think all of us know the answer to that. So don't be afraid of the 401k option if it's in your plan. The problem is a lot of 401k plans don't have that option. But if you do, you might want to think of putting some money into that versus not. It could be a real game changer for you down the road when you do retire.
Mm-hmm. It's so important. Go ahead.
Yeah, the time that you have invested, right, is going to be the same either way. So if you can do it in a tax-free account, that really is a big benefit. And then this one, we get asked this a lot. Can the taxes that you owe on the Roth conversion be deducted directly from the amount that you're pulling out of your IRA? It can, right? You can pay taxes out of that account. That's not typically the most beneficial, because you're taking, let's say, $40,000 from your IRA, pulling it out, paying the taxes, and then only putting in $35,000 into your Roth, right? Yeah. Hypothetically speaking. So now you have less money invested. So for it to really be as beneficial as possible, we want to pay taxes on that money with money that maybe we have in checking and savings or from our paycheck, instead of doing it from the conversion. Not that you can't, it's just more beneficial to do it the other way. But we get it. All these questions do have an impact on one another.
Yeah. In fact, if we can use non-qualified money, after-tax money, to pay the tax, that's ultimately what you want to do. You don't want to do it the other way around, because Casey hit the nail on the head. If you take qualified money to pay the tax on qualified money, you're kind of robbing Peter to pay Paul. Yeah. So we would tell you, don't do that if you have other monies that you can use.
Tell you, when we hit the scenarios, listeners are out there, wow, man, I tell you, I've got an interesting scenario, but it's all mine. I need to talk about it. You can grab a spot on the calendar with Elevated Financial Management. You're leaving the checkbook at home. If you've saved $250,000 or more towards your retirement, again, these strategies are going to work best for you. How do you grab an appointment? You call this number, 866-668-3625. Again, complimentary, 866-668-3625. And this is about helping you see if you're on the right track. And if you haven't even gotten on the track, if you're just sitting on the portfolio, excellent opportunity. 866-668-3625. All right, next scenario, gentlemen, is this one. I was terminated by my employer. Paperwork they sent me said a 10% penalty for an early 401k withdrawal would be waived for payments made after separation of service if you turn 55 during that year. This might as well have been written in hieroglyphics. What can I do to avoid the penalty if I don't turn 55 until into 2026?
Yeah, so this is something where you need to just understand the rules. And they can be complicated and they can be a little daunting. And that's why he said, hey, this might have been written in hieroglyphics, right? So a withdrawal is different than a rollover, right? Because if you're terminated from service, whether you're fired or you quit, you can take that 401k plan and you can roll it into your own IRA, and it's a non-taxable event. Nothing will happen. Now, if it's a withdrawal like this question is talking about, that's totally different. So if you want to take money out and you haven't turned, 55 yet, now that's going to be a problem because you are going to be faced with a 10% penalty. But if you are 55 or older, we can do what's known as systematic withdrawals and systematic payments. And as long as it's done for 5 years or more, then you're able to take money out and forego the 10% penalty, because we all know penalty of 10% is fairly significant. Nobody wants to do it. And again, depending on how bad you need the money and for what reason, maybe you have to do it. Maybe you have to, deal with that penalty. You can't get around it. But a lot of us should stay away from this money for withdrawal purposes, right? We've designed it for retirement. Make it your retirement money, because if we go and we start to take it out early and we cannibalize it, start eating it up, we're going to have regrets at the end, right? We're just going to have the pain of regret versus the pain of discipline. And so it's something we all need to really think about. You need to have a plan for taking money out of these erzy, for sure.
So true. I mean, the key word there was plan. You don't just do it. I mean, you need to talk about it. You need to, strategize and really do it the right way. All right. So final scenario, we'll hit it real quick. And here it is. I keep getting calls from folks looking to sell me precious metals or convert my IRA into gold. Is this legitimate? And if so, is it smart or is this just spam?
It could just be spam. It's really hard for us to say. I think that maybe the better question is if you are considering moving your investments to precious metals or to gold, that kind of thing, you would want to potentially think about, do you actually want to own those physical items, right? Do you want to hold gold? Which we have some folks that have come into our office that have $1 million plus in gold bars or gold coins, and they have a safe and all these things. And not that there's anything wrong with that per se, but do you actually want to have to house all of that and deal with the safety that you need to have to do that? Or do you want to purchase gold shares in a trust or something like that, right? Which would be very different. You could do that via an ETF. There's lots of options there, which is easier. That's easier to get in and out of. It's easier to purchase. It's easier to liquidate. Are the calls that you're getting legitimate? We don't know, right? Some of them may be, some of them may not. We won't comment on that too much. But the big question is it smart, right? Is that the best way to invest? We think that gold, precious metals, does have a potential place in a lot of people's portfolio, but that's just it. It's a piece of the puzzle. It's not the whole puzzle. So to think about moving, even more than 10% of your portfolio into gold or precious metals, that would be a pretty heavy approach into just one thing, right?
Heavy approach. I like it. Heavy.
Yeah, heavy metals, right? If you were to talk about taking a position of that size, 10% or more, in any one individual stock, pretty much any advisor is going to tell you, maybe pump the brakes. That's maybe not your best move. So to do that with gold or to do that with any precious metal or even a culmination of all of those may not be your best move. It'd be better to have a plan that incorporates those items.
It starts with a conversation, and that's what we're going to give you right now, opportunity. Mark, we've got spots on the calendar. Walk us through it.
Please, if you've been listening today, pick up your phone and maybe you were thinking about, well, what should I do when it comes to commodities, precious metals, things like that? What about your tax planning? Do you have a plan to figure out which bucket you want to draw money from an income source? Is it guaranteed for life? please pick up the phone. Let our team of certified financial planners put together a plan for you based on your situation. It's going to be, you can keep the checkbook at home. There's going to be no charge up front for this. And so please pick up the phone. Let us help you, give you a way to get through your retirement and make sure that your money lasts the whole time.
The feeling of confidence is a wonderful feeling. You know, working with professionals, fiduciaries that do this on a daily basis, you're going to have confidence. And this is your opportunity right now. If you've saved $250,000 or more towards your retirement, these strategies are going to work best for you. Call now, secure one of these appointments, leave the checkbook at home. 866-668-3625. 866-668-3625. One more time, 866-668-3625. For Mark, Casey, I'm Morgan. Another edition of Elevate Your Wealth is in the books. We'll see you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.